If you're a real estate investor and thinking about selling your property, you've probably heard something called 1031 exchange. It's one of those powerful tax strategies for real estate investors out there because it lets you defer a capital gains tax when you sell an investment property. Hi, I'm Matt on EA with Anand Company. Today, I'll break it down in simple terms. We'll look at what it is, how it works, and what key rules that you need to know. Let's dive in. A 1031 exchange, named after Section 1031 of the tax code, allows you to sell an investment property and reinvest it into another like-kind property without paying capital gains tax. This means that if your property's value went up, you don't have to pay a big chunk of tax to the IRS right now. You can roll those gains over to your next property. Here's an example. Let's say you bought a rental property for 300K and you sell it today for 500K. Usually, that 200K gain would be taxable, but if you use a 1031 exchange, you can take all 500K and reinvest it into another qualifying investment property. The tax is deferred, so you don't have to pay it now. You push it into the future. All right, here are some key rules that you should be aware of. Like kind property, both the property you sell and the one that you buy must be for investment or business use. A rental property for another rental property works, but you can't exchange your personal residence. Timeline, you have 45 days from the sale to identify a new property in writing and 180 days to close. If you miss the deadline, you lose the benefit. Qualified intermediary, you can't take the sale proceeds into your own bank account. A middleman called a qualified intermediary has to hold the funds until you close on the new property. Then, why investors use it? This is how investors grow faster. So, check this out. Let's say your rental property more than doubled in value and you're selling it at 500K. You could reinvest into multiple rental properties instead of one. You could reinvest 200K for a single family home and 300K for a duplex. Then you're building more income streams from multiple rental properties instead of losing money by paying capital gains tax. A 1031 exchange is a great tool to build your real estate portfolio while deferring taxes, but it comes with strict rules and deadlines. So planning ahead is key. I'm an EA specialized in small business and real estate taxes. Plus, I'm a real estate investor myself, so I understand ins and outs when it comes to running rental properties. You want to make sure you're not missing out this big benefit of 1031 exchange? Schedule your free tax discovery call with me today. We'll make sure you save more with confidence. The link's in the description below. Now, here's what to watch out for. If you pocket any of the money called boot, it's taxable. State rules can vary, so check your state requirement. And remember, this is a deferral. You still owe tax down the road unless the property is passed to your heirs who can benefit from a step up in basis. To recap, a 1031 exchange lets you sell an investment property, reinvest into another, and defer capital gains tax. Just remember three big rules. Number one, property must be like kind. Number two, you've got 45 days to identify and 180 days to close. And number three, a qualified intermediary has to handle the funds. When used right, it's a powerful way to scale your portfolio and keep more money working for you in real estate. All right, that was all I have for today's topic. If you have any questions around your taxes, feel free to reach out. I have my contact info in the description below. If you find this video interesting, please like and subscribe. Thanks for watching.